Okay, just looking at the financial results for the half year ended 28 February 2013, some highlights. You'll see that the half year distribution is 33.7 cents. That's growth of 7% on last year, and it's at the upper end of our market guidance that we provided at the end of last year. The accounting treatment of Redefine International has been simplified. We've now deconsolidated Redefine International, and it's now accounted for as an equity associate, which means that our balance sheet is hugely simplified and our credit metrics have been enhanced. I'll go into a lot more detail shortly on that. Our tangible assets, as you can see, have grown to 31 billion rand, and our net asset value, mainly due to the deconsolidation of Redefine International, has improved. It's grown from 8 rand to 8.31 rand in this period. Our market cap is on 30 billion rand, and that is before the additional units that we intend to issue towards the end of this week that have arisen from the accelerated book build that we conducted last week, whereby we raised 800 million rand. The presence in the debt capital market continues, and we have recently issued a further 1.5 billion rand at very favourable terms, further strengthening our position in the debt capital markets, and we intend to go there for some more funding in due course. Our local contribution is up 9%. We're very pleased with that. A lot of that growth has come from restructure benefits that began during the course of 2011 through 2012, and now we're starting to see those acquisitions coming through quite nicely. And once again, I'll take you through a slide which deals all with that, that growth story. Looking at core property margins, we are pleased to note that they've grown by 1% on our core business, and that's come through cost containment, which once again I'll explain in a lot more detail. Our average cost of local funding has grown by 30 basis points, or it's reduced rather to by 30 basis points to 8.6%, and there will be more savings to come as a result of the further presence in the debt capital market in the second half of this year. Moving then just onto our corporate structure. 2013 first half has been quite uneventful. However, there have been two significant events on our corporate structure. The one being Redefine International has reduced down to an effective holding of 32.5%. It was around 39% last year. And Redefine International Fund Managers, we increased our investment there to 90%, which is an increase of about 14% on last year's shareholding. And then just to add, post the reporting period, we have increased our holding in Cromwell by a further 6%. And in terms of Hyprop and Fountainhead, we've reduced Hyprop to about 11.4%, and Fountainhead has grown to 45.6%, mainly through a switch of those two units. And there's been some cash as well as Redefine units issued as well to fund that extra investment in Fountainhead. Looking then just at the distribution for the first half of 2013, stripping out non-recurring fee income from the prior year and also the dilutionary effects of the additional units in issue that arose from last year's shares that were issued, you'll see that growth of 9.3% in distribution terms was achieved. And then if we look at the full distribution of 33.7 cents, you'll see it's grown by 7% on 2012. Just looking at contributors to distribution per linked unit, you'll see that the biggest contributor to the distribution comes from our core property portfolio, where approximately 80% of our income is derived from our core property portfolio. Once again, we are pleased to note that there's no reliance now on non-recurring and lumpy fee income, and the local operations have generated 90% of the total distribution. Just looking at drivers of the growth in distributable income, this slide takes you from the actual result last year of 846 million, and we build it up to the 930 million rand that we are distributing in this period. You'll see that 96 million of the growth comes from the core property portfolio, and you'll see that about half of it, almost about 49% of that 96 million comes from the new properties that we've acquired. Listed securities has declined slightly, mainly due to the sale of some Hyprop units, the disposal of Oryx last year. And then just to note that the associates have declined by 5 million rand. That is mainly due to the moving of Cromwell to the listed security line because of the change in holding in Redefine International. Fee income, it's at 44 million rand and growing. The main reason for that is because of the Fountainhead Manco that we've acquired. About 2/3 of that number is purely Manco income, and it's recurring income. And you'll see that Redefine International has grown about 15 million rand. That's mainly due to the benefits of the capital raise last year, as well as the rand weakening against the pound. Just to go back to finance charges, have grown by 53 million. That's purely driven from additional funding. Our debt increased by 1 billion rand since last year. Looking then just at the distributable income, broken up into its components. I've already covered the percentage changes, and this just provides the full numbers for one to compare to last year, so I won't dwell on the slide. Looking then just at the core property portfolio. Now, core properties are those properties that we've held for 6 months in this period and in 6 months last year. So they're in for full periods on both sides. You'll see that the income has only grown by 4.8%. I'll explain in detail why it has grown by such a percentage. And as you can see, the 6.3% growth on the core property portfolio line has arisen as a result of the core property costs being held to last year's levels, which I will once again explain in due course. The balance of the growth, as you can see, comes from newly acquired properties in 2012, which are in for a full period during 2013, giving the balance of the growth to 10.3%. Also pleasing to note, as you can see at the bottom, is the core property margin growing by just over 1%. Looking then at core property revenue, you'll see the 4.8% growth is driven by letting activity. If you cast your eye to the new lets, a total column, you'll see that we gained 19 million rand in revenue from new lets. That translates into growth of 1.9%. However, offsetting that is revenue lost from vacancies of 29 million rand, which is a negative 2.8% growth. So if you combine the two lines, you'll see that we went backwards by about 1% as a result of vacancies exceeding new lets, and that has arisen mainly in the office and in the industrial portfolio. You'll see that the retail portfolio has done very well this period. It has grown on 2012 by 6.7%, and its new lets and its vacancies have offset one another quite nicely, which has enabled that to come through. Offices, as you can see, are battling. Vacancies are 9 million rand versus new lets of 3. And similarly, industrials suffered a loss of 13 million rand versus 9 million on new lets. Looking then at core property costs, as you can see, we've worked very hard here to keep our costs growing at 0% overall, and there are swings and roundabouts on all fronts. As you can see, net municipal charges, there's been a big pullback there. There's been a number of accruals that we've been able to release that are no longer required. We've also been able to restructure new leases, and also as a result of the new acquisitions and a move to single-tenanted properties, we are able to improve on both the recoveries for municipal charges as well as electrical charges. Looking forward on electrical charges, that is a line that's going to move into positive territory as a result of the acquisition of the rural recovery of electricity business. Operating costs have grown somewhat, but that's due to a reallocation of costs from admin, which you don't see on the slide, that have been now allocated to this line. Property management is well controlled at growing at 2%. Repairs and maintenance, although down just under 9%, that's a timing issue. And in the second half, there'll be some catch up on that cost line. Tenant installation costs and letting commission, those are costs that are deal driven. Management fees have grown 14%, and that's mainly due to the outsource of facilities management in the coastal areas. And then you'll see a decline of 11% on bad debts. mainly due to last year having a higher than usual level of bad debt write-offs. Looking then just at our cost metrics, you'll see that on every count there, whichever one you choose, you'll see we're moving in the right direction, going back to 2010, which was our base year before we internalized property management. We're very pleased with all those percentages. They're moving in the right direction. Just looking at our margin or the efficiency of our trading for every 100 Rand, how much converts into property income. If we go back to 2010, you'll see it was 75 Rand or 75%, and that's grown to just over 76.5%. So over the 3-year odd period, you'll see we've improved our margin by about 1.5%, and that's principally arisen from the second line from the bottom. It's on management fees. You'll see in 2010 it was 4.5% of revenue. It's now just under 1%, and that's due to the internalization of property management in the main. If you cost that number out, that's a cost saving over the period of 40 million Rand in perpetuity that we achieve as a result of that internalization. Looking at our balance sheet, as I said earlier, it's hugely simplified. We've now removed Redefine International from our balance sheet, and it's now accounted for in the associates line. I'll deal a bit more on the debt side, which as you can see compares very well now to our asset base. Our loan to value is now about 34%, and our NAV, which I'll talk about shortly, has been hugely improved as a result of stripping out debt and assets of almost an equivalent amount. Looking at our net asset value, going back to 2012, February, you'll see that we've grown it by about 10.5% to just on 8.30 Rand over the period. And you'll see in the current period versus last year, we grew about 30 cents, and 2/3 of that came from the deconsolidation of Redefine International. Looking at our funding, you'll see that at the end of the first half, we had just over 10 billion Rand of debt. It is about a billion Rand greater than last year. And as you can see, there's a small component offshore that's in respect of Redefine International fund managers, with the bulk being onshore, being 10 billion Rand, with 800 odd million thereof from the debt capital market. Our intention is to increase that to about 30% of our total debt. And as I said earlier, subsequent to the half year, we did raise some bonds totaling 1.5 billion Rand subsequent to February. Looking then just at loan to value, as you can see, slightly under 35%, which is just in line with our target. Our percentage of assets secured has dropped from 74% to 66%. Our weighted average cost of borrowings have similarly declined, and our percentage of debt that's been fixed is being maintained within our management target, sitting at 66%. Our average length of fixes is just on 4 years. And I'm pleased to draw your attention to the fact that Moody's credit rating has remained unchanged during this period. And I just want to draw your attention to the fact that subsequent to the half year, as I said earlier, we did raise 1.5 billion from the debt capital market, but in addition to that, a further bank debt of 1.1 billion Rand was raised. And we also undertook an accelerated book build whereby we raised 800 million Rand last week, taking the total funds that have been raised since the half year to about 3.4 billion Rand. Looking at our abridged cash flow, the main line to focus on would be our local achievement, which is the first column. And you'll see that we've been very careful in managing our cash, whereby every surplus Rand that we generate, we apply that to debt, so that on our revolving credit facilities, so that we don't have any unproductive cash on hand, and that is used to partially fund investments. So as you can see over the period, we comfortably covered through our cash generated by operations, our interest burden, as well as our linked unit holders distribution, leaving us with a cash surplus of just under 140 million Rand. And then we had investments of just on 1 billion, and we raised funding during the period of 900 million. giving us closing cash of 17 million rand. Now that 17 million looks low, but within that 17 are revolving credit facilities sitting in the funding line above, which we can draw upon to meet immediate cash needs. Unit holder profile, as you can see, our top 10 unit holders comprise just under 42% of our shareholding in total. And it's interesting to note that State Street, I've highlighted it in green, is the only international investor in the top 10, but now holds 5%. So it's jumped up into the 5% range. And as you can see, Stand-up have been and still are our top shareholder, a beneficial shareholder at 6.6%, followed by the Government Employee Pension Fund at 5.5%. The usual suspects make up the balance. Just in terms of foreign ownership or international ownership, you'll see that over the last 5 years or so, Redefine's foreign shareholding has grown 10 times from about 1.4% to 14.5%, with the bulk of the international holding coming from the States, sitting at 6.6%. Looking then at Redefine's investment story, you'll see that we make a compelling case to be invested in Redefine. Redefine being the red line, as you can see, has comfortably tracked the SA listed property index and has beaten the all-share index comfortably, as well as the bond index. And this is over the period to February 2013. If we had to draw this line on for the last couple of weeks, I think Redefine would definitely be in the upper range on a consistent basis. Looking at the total return for the 12 months to February, you'll see that the total return for Redefine, if you were to hold a unit from the 1st of March 2012 through to 28 February 2013, would have given you a total return of 33.3%. 75% of that 33.3% comes from capital growth. Your unit would have increased in value by 195 cents or 25%, and the balance would have come through in distributions. And those distributions would have been the second half distribution for last year, as well as the current declared distribution for this period, taking the growth to 8.4% and in total 33.3%. And that's it.